Retire on December 31st and you can walk away with a full bonus, a completed 401k match, and a clean tax year. Retire 2 days later on January 2nd in the exact same job and you can lose all three. Plus, if your timing is off elsewhere too, thousands of dollars in Medicare premiums 2 years down the line. This video walks through the 4 government rules that make that 2-day gap real. The Social Security earnings test, Medicare's enrollment windows, employer benefit timing, and how the tax calendar treats a year that mixes salary with retirement income. Start with the earnings test, since it only matters if you claim Social Security before full retirement age while you're still earning money. For 2026, if you're under full retirement age all year, Social Security withholds $1 in benefits for every $2 you earn above $24,480. Earn $10,000 over that line, and you'd lose $5,000 in benefits for the year. There's a separate higher limit in the calendar year you actually reach full retirement age. For 2026, that limit is $65,160, and the math is gentler. Social Security withholds $1 for every $3 over the line, and only counts earnings from before the month you turn full retirement age. There's also a first-year special rule that works differently. Social Security will pay your full benefit for any month where earnings stay under $2,040, treating it as retired no matter what you earned earlier in the year. Retire in June with a high salary and claim benefits that same month, and July through December can still pay in full under this monthly rule, even though your January through June earnings alone would have blown past the annual limit. If your benefit runs $1,500 a month, 6 months of full payments is $9,000. An annual-only calculation would have put at risk. Withheld benefits are never simply gone either way. Once you reach full retirement age, Social Security recalculates your monthly amount to credit you for the months it withheld, so the effect is a lower check now, not a lower check forever. Medicare runs on its own calendar, and it won't wait for the earnings test to sort itself out. If you're retiring at or after 65 and losing employer coverage, you get an 8-month special enrollment period starting the month your job-based coverage or employment ends, whichever comes first. Here's the trap. Electing COBRA does not extend that window. Retire in January and use COBRA to bridge the gap, and your 8 months to sign up for Part B still started in February, the month your job ended, not whenever COBRA runs out. Miss it, and the penalty is 10% of the standard premium per full 12 months without coverage for as long as you carry Part B. The fix: apply in the weeks before your last day of work, so coverage starts when employer coverage ends instead of leaving a gap. Employer benefits close out on their own schedule too, and this part depends on your employer, not on any government rule. Year-end bonuses, 401k matching contributions, and paid time off payouts are often tied to being employed on a specific date, commonly December 31st. Retiring on December 30th instead of January 2nd, same job, can mean the difference between receiving that bonus or match and missing it. There's no substitute for reading your plan documents or asking HR what your specific vesting and payout dates are. Now the tax year mechanic, where the biggest and least visible money tends to sit. The number that matters is what the tax code calls provisional income, your other income plus half of whatever Social Security pays you. Retire on December 31st and your final work year shows a full year of salary, while the next year shows a clean year of retirement income, never mixing. Retire mid-year instead, and that 1 year blends months of salary with months of retirement income, pushing provisional income higher than either stream would have reached alone. Cross $25,000 in provisional income as a single filer, or $32,000 as a married couple filing jointly, and up to 50% of your Social Security benefit becomes taxable. Cross $34,000 as a single filer, or $44,000 as a married couple, and up to 85% becomes taxable. These thresholds haven't been adjusted for inflation in decades, so more retirees cross them every year. There's a second, slower-moving trap layered on top. Medicare's income-related monthly adjustment amount, called IRMAA, looks back 2 full tax years, and it's a cliff, not a slope. For 2026, that surcharge applies once income from 2 years earlier exceeds $109,000 for a single filer, or $218,000 for a married couple. Here's what a mixed year can do. Say a single filer earned $70,000 in salary before a mid-year retirement, then $30,000 in retirement income the rest of that year. That's $100,000 total, safely under the threshold. Add a modest payout, a bonus, or unused leave, bringing that year to $112,000, and the threshold is crossed by $3,000. 2 years later, that crossing has a price. The standard Part B premium of $202.90 jumps to $284.10 a month. That's an extra $81.20 monthly, close to $975 a year, before any Part D surcharge, and doubled if a spouse is affected. A year split cleanly across 2 tax years might never have crossed that line, though whether yours does depends on your own numbers, not a rule of thumb. So, which month is best and which is worst? 3 of these 4 mechanics point the same way for most people. December 31st, since it closes a clean tax year, catches most year-end employer benefits and avoids mixing 2 incomes into one IRMAA triggering year. That's the closest thing to a default here, not an automatic answer. If you're not yet at full retirement age and plan to claim Social Security right away, the earnings test can matter more. If you're turning 65 this year, Medicare's clock runs on your birthday, not the calendar, and can override the default entirely. The costliest outcomes come from picking a date for convenience and never checking it against your earnings, your Medicare window, your plan's vesting date, and your tax year. December 31st is a place to start that check, not a place to stop it. Run your own numbers against these thresholds, or sit down with your HR department and a tax professional before you sign anything. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing. Subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.